Hey, good afternoon, and welcome to today's top 10 stock pick sneak preview. You got John Hopkins here. Tom Bowley going to jump in just a minute. If you're new to Earnings Beats, I want to welcome you. Appreciate you taking the time to stop by. Very timely to come in with the market in free fall lately. And of course, welcome to all of our wonderful subscribers, many who have been with us for years. Thank you so much for sticking with us. Today's event will be recorded like all of our events. So if for some reason you can't stick around, don't worry about it. We'll make sure you get a copy of the recording as soon as possible. Today marks the first of a number of webinars that are coming up during the month of May. This one in particular is a sneak preview to our top 10 stock picks, which will come out on the 19th. So that'll be next week. And then we've got, of course, our Max Payne webinar and a few others that are coming up that you'll learn more about over the next couple of days. Tonight's what we call a public event, open to all members of the Earnings Beats stock charts communities. When we get to the actual top 10 stock pick session, that will be a member only event, given the information that's going to be shared. Anyways, I'm going to see if Mr. Bowley's around. How's it going, Tom?
I think I'll just let you handle this one.
You know, I had the 42-1 shot in the Kentucky Derby, came in fourth. If I had only had the 80-1, then that would have been nice. I will say that. But speaking of odds, I'm looking at the market, and by the way, folks, Tom and I communicate daily about the market, different thoughts, strategies, whatever, and particularly for those of you, I gotta give you some props. For those of you who have been, with us, you've seen and heard Tom, going back actually to a Market Vision 2022 event that occurred right at the beginning of January. And a lot of caution on the market. And, Tom has been correctly bullish for many years. So when he starts talking about a problem market, I pay attention. I hope a lot of others have as well. And ever since that particular event, Tom really has remained on the cautious side. I'm going to be listening very intently. I know you're going to be talking, more about the top 10 stock picks, but I'm imagining you'll share some information on the market as well. And I was, Tom, I was looking at the, portfolios. Nobody ever likes to be down, but in looking at our, three portfolios, certainly through Friday, we're pretty much tracking the S&P. I think the income was beating it, and maybe one of them was down a couple of points more. But I think about some other people who have been, coined, real experts, and looking at what's happened to the portfolios they're in charge of. And all I can say is a lot of portfolios have been damaged dramatically by people who are supposed to be, some of the best money managers out there. And I think, it's one of these times where you and I have been around long enough that even when things look horrible, they can get even worse.
Mm-hmm.
Right? I mean, you see a stock down 70% and you say, oh, that's it, I'm in. They're still down another 30%. And that extra 10 or 15%, can be very painful. And I've also seen, Tom, that when the NASDAQ goes down, 3%, 4%, you're holding stocks that are right now, let's say the high, the tech high growth stocks, they're not down 3 or 4%.
No.
They're down 12%, you're seeing stocks daily, 10%, 12, 15%. Finally, the S&P broke 4,000, which I'm glad, by the way, because I just want to see, at some point, maybe everybody gives up in unison and we say, now we've got a tradable bottom. Are we getting closer to that?
Is that a question for me?
Question. Yes, I'm listening. Is that a question?
Yeah. I mean, every drop we take is getting closer to the bottom. I mean, I know that a lot of folks are maybe just realizing what's going on here with the market and starting to freak out about it a little bit. But this is something we talked about at the beginning of the year and said this was going to require patience. It wasn't something that was going to be, we were just going to be able to snap through like some of the other pullbacks, where we've gone back, gone down for maybe a couple of weeks or maybe a month, and then that's it. I mean, this was started talking about a cyclical bear market back when the market was at an all-time high. So it takes patience, and these cyclical bear markets, sometimes they can run their course in a month, but sometimes it takes up to, 3 to 6, maybe even 9 months. That's kind of on the longer end. I would say 3 to 6 is more normal, but even that takes us all the way through the end of June. And here we are, still in the second week of May. So I think we got more to have to suffer through here over the next, few weeks to a couple months, maybe a few months. But I think we're getting closer and closer to a tradable bottom. And I think we'll hit that bottom when no one in the market believes we can bottom. And that's kind of the way it's starting to get now. Remember, back at the beginning of the year, I said we needed to reset sentiment. Everybody thought the market couldn't go anywhere but up. Options, it was the most bullish that the options world had been in the last 15 years by far. And I'm going to go through some of these charts and show you, if you're new to earnings beats, what I'm talking about. But we are moving in that direction. We are in the process of resetting, and everybody needs to start getting more and more bearish, and we're starting to see it. I love yesterday. I'm going to show everyone an article. One of my favorite people in the world, a lot of sarcasm here, Peter Schiff. I mean, this guy comes on CNBC and he's a broken clock. He talks about the market being absolutely way overpriced and we're going to collapse and tech's going to get absolutely killed. And he says this all the time. And then they parade him on CNBC whenever the market starts to get hit. No accountability for everything that's been said the last 5 or 10 years while the market's going up. But then as soon as the market starts to really struggle and fear starts to ramp up, then we hear from Peter, my good old buddy Peter. And they talk about how, I think it was in an article, I'm going to show you in a minute, but I think in this article somewhere, I saw that he had, they were mentioning that he called the financial crisis in 2008. Of course he did. He calls it every year. He calls a catastrophe right around every corner. And so when they hit, then they always bring up, well, you called this, you said that this is what was going to happen. I mean, he drives me crazy because a lot of folks listening into CNBC probably think the guy's some kind of genius. And I think it's an absolute scam. I don't know what the heck's going on, but every year he talks about the market being ready to collapse. And now that the market's going down, now this is a reality check to investors, according to Peter Schiff. But anyway, I'm going to start with that and show you this article in just a second. But it's, yeah, I mean, this is kind of a market when we start seeing the market crater and the fear starts to ramp up. That's when we get all these perma bears coming on the CNBC, flexing their muscles like, they've called it again, but they're always calling it. Anyhow, that's almost all the rant I'll have. I'll have a little bit more, but are you ready to get going?
Yeah, let's go ahead and let's get rolling.
All right. I think what we'll do is go ahead and start with our agenda. And I'll try to make this as quick as possible tonight. I mean, normally it's an hour, so I'll shoot for 5:30 Eastern. If you need to leave for whatever reason, this is being recorded. You can always check back in. It's really just it's like going to the doctor and getting a physical and, checking all the vitals and everything. That's really what I'm doing tonight. I'm just going to go over a lot of the same charts that I go over every quarter to kind of take the pulse of the market, see what's working, what's not working, what we need to look for, the themes that are out there, the things that are hurting the market right now and that need to change, All those things we're going to talk about. And then I'll kind of look at all of those things and all of those current themes and try to give you a little bit of insight into what I'm looking at in terms of the portfolios for the next 3 months. Of course, the actual draft and what the stocks that go into the portfolios will be next Thursday. While this is a free event, that is a member-only event next week. So if you do like what you hear, it's a great time to take out a 30-day trial if you're a non-member of Earnings Beats, because while you do have to give a credit card, there's no obligation whatsoever beyond, trying us out for 30 days and seeing if we're a fit for you. So keep that in mind as we go through this. The agenda tonight, current conditions, like I said, just going to go through, show you what I'm seeing. Some of it may be new to you. Some of it might be a refresher if you've been with Earnings Beats for a while. But I think all of this is going to be very information packed and very educational, hopefully. Sector industry relative strength. I mean, when I start to put the portfolios together, that's one of the first things I turn to. What groups are leading the market from a sector perspective, and then industries within those sectors, where are our leaders, and then try to find the individual stocks that are leading those groups. That's the way we try to build out these portfolios. Over time, they've done really well. From time to time, because we are, for the most part, growth investors. I believe we're in a secular bull market, and I'll talk about that in a couple of minutes. But as a secular bull market investor, I want to be in mostly growth stocks. Now, we've kind of adjusted that over the last couple of quarters, couple of drafts that we've done, because the market's just not in that environment. It's not a good environment for growth stocks. So while we may be right around the S&P 500, maybe a couple of our portfolios might be underperforming a little bit, I think what you really need to do is look at how we're performing versus many other growth funds. Look at the ARK funds. Look at the IBD 50 fund. We're outperforming those by a wide margin in 2022. And it's because we saw the growth issues coming up and we adjusted for them. We still have some growth in our portfolios, but we also have more value than we normally have. And that's what's kept us out of big trouble so far in 2022. And to be quite honest, I'll be looking at some of those same things over the next 3 months, because I'm just not sure. We're certainly not out of the woods yet. And I don't know when we're going to turn the corner. But anyway, we'll go through all that. And then I'll show you some individual stocks that I think look interesting before we wrap up today. All right, so let's go ahead and jump in. Before I get into the current conditions, though, I do want to show you this article. It was over at Yahoo Finance. I mean, I can't do anything but laugh. First, I want to make sure, John, can you see the screen? Yahoo Finance, this article. Or Aaron?
Yeah, I see it.
Okay, good. All right, I just want to make sure my screen was up. Okay, so here it is. Peter Schiff says overpriced tech stocks are going to collapse as air comes out of that bubble. Now, this was Saturday, May the 7th. Anybody been watching tech stocks for the last 4 or 5 months? Because they've been going down for 4 or 5 months. Some of them have already collapsed. I mean, if you're looking at any of these small cap and mid cap tech stocks, oh my gosh, they've been absolutely pummeled. I've seen stocks going from 60 to 10. And now Peter Schiff's coming out saying they're going to collapse as the air comes out of that bubble. And everyone treats this guy like he's some kind of genius because he called the collapse in 2008. Like I said, he calls the collapse all the time. But I mean, my stomach gets upset when I just see his picture because I feel like there's so much misinformation that is broadcast when he's on CNBC. I'd love to know what the returns are on his hedge fund. I mean, he either is not telling the truth as to what he's investing in, or there's no way he could possibly be making money. He's always talking about shorting U.S. equities, and for 10 years, they've been going up. I don't know how he does it, but anyway, he's their chief global strategist. Good luck if you're following some of what he has said in the past. But and I'm really not, I don't know what the right word is. I guess I'm just kind of perplexed that CNBC given his long-term track record, continues to bring him on the show every single time the market starts to go through a rough patch. But anyway, I guess that gets them the ratings they need, gets them the money. It's a lot more interesting and all to talk about the train wreck that's in front of you than to talk about the Boy Scouts and, you know, what they're doing for the community. Anyhow, that's enough. I'll be done with that rant now. So let's get rid of that. And let's go ahead and take a look at this long-term secular bull market that we're in. And once again, I mean, you think about where we are right now, and all you can do is just kind of focus on the last 3 or 4 months and how difficult it's been. We talked about it back in January 8th, Market Vision 2022. I had this discussion. I'm going to show you some charts that I forecast, and the market is almost exactly on a path that we talked about back in January. I wrote an article in Chart Watchers, I think it was December 31st, saying 2022 was going to get off to a rough start. You can kind of see some of these things from time to time coming before they hit, and you can prepare accordingly. It doesn't do a whole lot of good to start warning everybody 5 months after the market's gone down. I mean, the NASDAQ's already down, what, 25, 26, 27%? I mean, it's already deep into a bear market. With the exception of maybe 2000s and 2008, 2009, this is the time to buy the NASDAQ. Almost every other time in history, if you get a 25% pullback in the NASDAQ, you can start buying. Now, do I think we bottomed? No. Do I think that if you started buying now, yet that money would make money a year from now? Yeah, I think that you'll be well ahead. Anything that you're buying in the NASDAQ today versus where we're going to be a year from now, I think would be a great investment. Again, just my opinion. I'm not a registered investment advisor. I can't possibly know what's going on in everybody's personal lives from a financial perspective. We don't, you know, it's impossible from Earnings Beat's perspective to have a one size fits all, where here, everybody do this with their money. I don't know what position everybody's in. I don't know. Some of you are retired, probably very interested in protecting your capital. Others of you, maybe younger, many years to retirement, want to go for the fence, you know, swing for the fences. All I'm saying is, yeah, we probably have some more downside in the near term, but in my opinion, I think the market comes roaring back. And the reason is this part of the chart over here. I think we are in a secular bull market. I said it back in 2015 and 2016. I said it in 2018 during the trade war. I said it in 2020 during the pandemic, that we are in a secular bull market and that this too shall pass. Well, here we are, 2022, and I'm going to tell you again, I believe we are in a secular bull market. Yes, we needed this. We got outside the channel, which I'll show you in a minute, but we needed a pullback. Sentiment was crazy, way too bullish. Folks that got in the market after the pandemic that were new to the stock market, starting in March, April, May 2020, they didn't know what a bear market looked like. So every time the market pulled back a little bit, it's like, throw more money in. It's a casino, but it just keeps printing us money. Just keep throwing that money in. And it was working. For 2 years, it worked. It's not working right now. And it's not ready to start working just yet. So, you know, this pullback, I think, again, it's getting more and more mature, but we've probably still got more to the downside. The S&P 500 today closed below 4,000. On January 8th, I said minimum downside target, the S&P 500 was 4,300, minimum. I thought 3,800 was probably more likely. That would be the 20% bear market threshold. And I said, don't be shocked if you see 3,500. I thought 3,500 was possible. We're at 3,991 now and getting closer and closer. But a year, 2 years, 3 years from now, I think we're going to be looking back at this and it's going to be a blip on the radar, just like all of these other pullbacks, periods of consolidation have been. The stock market goes through these super cycles. And right now, money's still cheap. Yes, 10-year treasury yields all the way up to 308 or whatever it finished at today. Wow, 3%. I mean, I remember when my parents had a mortgage back in the 1960s and they got like 4% interest. And then when I had to go to buy in the 1980s, it was like 10%. And it was higher than that even, before I bought. And now, we've kind of gone through this cycle again where interest rates have come down. They're incredibly low. This is the way it was back in the 1950s and 1960s. During this secular bull market, rates were extremely low. In the 80s and 90s, it wasn't that rates were low, it was that the rates were coming down rapidly. Remember the fiasco we had back in the 70s with high inflation, high interest rates. So here was a secular bull market. We had plenty of pullbacks along the way, scary pullbacks, but we rallied off of them, kept moving higher. Then you go through these secular bear markets, which are really not fun. 12 years of going sideways, up, down, up, down, up, down, but nothing like the 50s and 60s where we kept going higher and higher, higher highs, higher lows with pullbacks along the way. Then we had 80s and 90s, higher highs, higher lows. Here's 1987 crash. I mean, I thought the world was falling apart. I was only 25 years old, 26 years old at the time. Just started working, put money away, was doing pretty good. 401ks had kind of started right then. I think it was around the mid 80s. Anyway, I remember being, feeling really good. And then in about 1 month's time thinking, wow, this is awful. Stock market will never be the same. Well, next 13 years, it looks pretty good. So again, that was a blip on the radar. We had the pandemic. That felt pretty bad 2 years ago. It's a blip on the radar. I think what we're going through right now, as bad as it is right now, as awful as it feels, you can point to, oh my gosh, it's inflation, it's interest rates, it's the recession, it's the war. There's so many things going on. Well, it was the same stuff that was going on back in 1991, really, when we had the Persian Gulf War. Crude oil prices jumped by 147%, way more than they've jumped for this war so far. We had a recession, we had rates going up, Fed was talking hawkishly. We had all the same things, 1990. 10 years later, you wish that you had invested during all that bearishness. So that's where we are right now. The question is not to me whether we go higher, it's when we go higher. And if you get in too soon, yeah, it's definitely going to be scary, depressing. I've said to members, if you're holding out, I thought recently it made sense to start building a position. And what I would do is be looking at now through September as kind of a time frame to build positions. And I don't know how you do that. That's completely up to each of you. And you don't even have to listen to me. You can, if you believe the market's going down for the next 5 years, that's fine. Everybody, that's what makes a market. We all have to kind of come up with our own thoughts where the market's going and come up with our own plans. I believe the market goes higher again. And I think a year from now, we're going to be looking back and we're going to see that this period right now through maybe the next couple months was a great opportunity to get in the stock market. Just my opinion. So there's the bull market, the secular bull market that I believe we're in. These last two secular bull markets lasted roughly 2 decades. These secular bear markets lasted roughly a dozen years. So you got 20 years, 12 years, 20 years, 12 years. If we started this in 2013, 20 years takes us to 2033. So if you're thinking about money right now and you have to have the money now to maybe, make ends meet for the next 2 or 3 years, then yeah, it's scary to be in the stock market. And I probably would not be in it either if I knew I had to have that money for the next couple years. As bullish as I am for the next year, I could be wrong. Now, if I'm looking out 10 years, you got money that you don't need for 10 years. To me, I would be buying stocks. History tells us that when we start pulling back this kind of a pullback, the majority of the time. Now, again, here's one period where a 20 or 25% pullback wouldn't have been a great time to get in because it ended up going down 50 or 60%. Same with 2000, the dot-com bubble. Same with the mid 1970s, the oil embargo. Back in the 30s and 40s, we had some pretty stiff sell-offs. but we're talking about a handful of times in history. All the other times, if you get a pullback like this, it's basically time to buy. So I think buying over the summer makes a lot of sense. Anyhow, I always like to start with this chart because it just kind of tunes out all the noise that we're hearing on a daily basis and worrying about, oh my gosh, the stock market went down today, 500 points on the NASDAQ, 700 on the Dow. This is awful. The S&P 500 is under 4,000. And then you read about it, you see it in the news all the time, and it just wears on you. I get it. But a year from now, I believe we're going to be a lot higher. So this is the chart that I like to look out to tune out all of that noise. All right. Next up. So I talked a little bit about resetting sentiment. And this was a chart that I showed back at the beginning of the year. This is the 253-day moving average of the equity-only put-call ratio. You might say, wow, that's a lagging indicator. Why would you want to look at 253 days? Well, essentially 253 days, it's kind of like, you know, when you're out in the Pacific Ocean and you want to turn around a speedboat, you can do it really quick. You know, you just turn it and you're back and heading in the other direction. But if you've got a cruise liner, I mean, it's not easy. To think back to Titanic, you know, when it was trying to turn that big ship and it ended up hitting the iceberg. You just can't turn it. You can't just see something and just make a quick turn. Well, sentiment is that cruise liner. You just can't make a quick turn. We went from extremely bearish. This was 2016. This is 2012. This was 2009 financial crisis. The equity only put call ratio, this is puts divided by calls. So when you're way up here, this is telling you lots of puts are being played versus calls. So there's a lot of bearishness when you're getting a lot of puts. But that makes sense. It took 2.5 years of bearishness to get us to that level. It took us a year, maybe 15 months, to get us from pretty bearish with the pandemic to extremely bullish sentiment in 2021. We were staying down here with a 253-day moving average of the equity only put call ratio at 0.46. Now, we never went below 0.57. And if I showed you all the daily readings of the equity only put call ratio going back the last 17 years, these 15 years over here, I'm not sure if we had more than 10 days that went down to 0.46, 10 individual days. And we got to the point where we had a 1-year moving average at that level. Not many puts being bought versus calls. This is the post-pandemic crew that just think you just make money, you just print money by jumping into call options. We needed to reset that. And that was one of the things I talked about at the beginning of the year. And when this is going up, when we're in the process of resetting, I want you to look at the market. When we're in the process of resetting here, we went nowhere on the market for 2 years. This is the S&P 500 down here. Here we go up. We went nowhere for 18 months in the market. 2006, 2007, I mean, throughout this whole process, we ended up going down. We were up for a little bit. But when we made this big move to the upside here, look at the market. When we're resetting, when we're seeing more and more bearishness in the options world, there's only one reason for it. And that's because the market is kicking everybody's butt. And we're selling off and everybody's starting to feel like we can't go higher anymore. Don't you feel a little different now than you did 4 months ago about everything? I mean, honestly, I don't think things are all that different, but it's portrayed a lot differently. I mean, yes, rates have gone up. Yes, we still got inflation worries. Yeah, we have the war. We didn't have that 4 months ago. There are definitely issues out there. I'm not saying they're not out there. I'm just saying This wasn't a structural issue, in my opinion, coming into 2021, 2022. This was, I think the inflation was pandemic induced. Everybody stayed home for a while, factories shut down. You don't have to keep producing goods if nobody's consuming them. So we shut down the supply side for a while. And then all of a sudden, we come back out of our shell and we're trying to build supply back up, and everybody has demand. Everybody wants to go travel. They want to go out to eat. They want to go buy things. And we don't have the supply. So it's post-pandemic demand that's surging and a supply chain shortage that we couldn't help. It was going to drive inflation higher. Now, the question was, how much higher? Well, we don't have a whole lot of, it's not like you pull out the post-pandemic inflation handbook. You know, we haven't done this for 100 years. Market was a lot different back in 1918 when we had the last pandemic. The stock market was completely different animal. I'm going off of history. I'm not that old. People, this is what I've read. I wasn't around. But that's my point. Nobody was around. What's the game plan? What's the handbook? What do you do in this kind of environment? I think we're all kind of figuring it out. I think the Fed is figuring it out. I don't think they're doing a very good job of figuring it out, but they're figuring it out. And they're going to overshoot. Right now, they're just trying to convince everybody they got inflation under control. That's why they say they're going to raise 12 times. They're not raising 12 times. If they raise one more time, yeah, they're probably going to raise one more time. Maybe. And I say maybe because we're going to get 2 inflation reports out before we have another Fed meeting. And I think both of these inflation reports are going to show inflation under control or getting closer to being under control. Anyhow, the sentiment is on its way up. I don't know where we top. I'm thinking probably 0.575, but it could be lower. But this is the reset that we're going through. And this is why we needed the market to pull back. I hate to say we needed the market to pull back because I don't like to see anybody lose money, but we really needed to pull back to launch higher. We had gone up so much in such a short period of time, 112% here in less than 2 years. That was probably 20 months, 21 months, 112%. Unsustainable. You can't go up that fast. Our economy doesn't grow that fast. These companies cannot sustain that kind of growth. We needed this pullback, and we're getting it. All right, S&P 500 since the beginning of the year. You can see we topped right there at the beginning of the year. We've been moving lower. Another lower low today, finished under 4,000. Growth stocks. This is the large cap growth relative to the S&P 500. We topped in December. We are now at a 2-year low. And these are the large cap growth. This is actually the best part of growth. Large caps, they've done better than mid and small cap. Then here we got the IWF, which is also large cap growth relative to the S&P. So you can see both of these getting hit pretty good. Then we had large cap growth, which this is just the absolute chart. You can see it's down to 4,500, which is we haven't seen since back in, was that March of 2021. So 14 months, we just hit a low. And then down here at the bottom is one of my favorite ratios. Actually, it is my favorite ratio, the XLY XLP. This is falling apart. This is screaming recession. I mean, I've been talking about recession. I said back when everybody was just getting on board with inflation that recession was going to be the next thing. Anybody who's been with earnings beats knows it's exactly what I was talking about. Forget about inflation. Next thing is going to be recession. And the recession is what's killing the growth stock, the large cap growth stocks. Apple and Microsoft have pricing power. Those large cap growth names, inflation didn't really seem to be bothering them. It was when the market started pricing in a recession. That's when the growth stock, these large cap growth stocks started getting hit, because a recession means less purchases. It doesn't mean, you know, people are still going to buy and just pay a higher price. It means they're not going to buy as much. Recession means a contraction of the economy. Well, if there's a contraction of the economy, everybody gets hit. There's no favoritism. Everybody's going to get hit. Some will get hit harder than others, but everybody gets hit. And that's what's going on with the growth stocks right now, the large cap growth. All right, so here's the inflation going back to the 1970s. This is just the monthly reading. This is where we are now. It's just a monthly CPI, core CPI reading. And then down here at the bottom, I have a 12-month rate of change. And here is the post-pandemic inflation that is hit. I think we may have topped right here. I'm not sure we're going any higher than 6.5%. And the reason is that the report that we're going to get on Wednesday, that's going to be the April 2022 core CPI. That's going to replace April 2021. April 2021 went up 0.9% at the core level. We're expecting April 2022 to go up 0.4%. If we hit expectations, this number's coming down 0.5% on Wednesday to 6% or thereabouts. And the next 2 months are going to be replacing 2 months where we saw big increases last year. It was right here. I don't know if you can see it on this chart, but we had a real big jump over 3 months. These are the 3 months coming up that are going to replace those. So when the Fed meets next, they're going to see inflation falling back. Now, they may go ahead and say, listen, we're going to still do a half, and then we're going to watch. I think that we're going to see inflation dip from 6.5 over the next 3 months back down to about 5 to 5.5. And then I think over the following 3 months, maybe July, August, and September, I think we might see it perk back up, maybe up over 6%. And then by the time we get to the fourth quarter, I see inflation coming down hard, and I see interest rates coming down. And I think there's going to be massive movement back into growth stocks. I might be wrong. I'm just telling you what I see, what I'm seeing on the charts and what I think is going to happen. We'll see. I hope I'm right. Here were the next 3 months, by the way, April, May, and June. You can see these really steep jumps. They're going to be coming out of the calculation the next 3 months. And it's going to be getting replaced by jumps that have not been nearly as significant lately. We'll see what happens on Wednesday. All right, so here was the core inflation rate again, right here. There's your 644. Here's growth stocks versus value stocks. So you see growth has held up pretty well. And that's what I was saying. Those large cap growth stocks didn't seem to mind the higher inflation. It was the fear of the recession that took the wind out of their sails. Mid-cap growth versus mid-cap value, they topped all the way back at the end of last year. Been going down since. Look at small caps. They were all doing well over the course of the last, going back to 2007. Remember, interest rates kept coming down. And so all these were doing great. When rates fell through the floor, that's when we had this last final surge. And that was relating to the pandemic, coming out of the pandemic. But now we're paying the price. And we want it to be over, but we've got to allow it to be over. We have to have the patience. It could be 3 or 4 months before we get to a bottom on these growth versus value numbers. I don't know where it's going to bottom or when, but I do think the next 4 months. So if I was sitting in cash right now, I'd be using the next 4 months to get back into my positions. If I got out of the QQQ and the spider at the end of the year and have been sitting in cash, I would gladly get back in starting now at these lower areas. Hold on 1 second. All right, sorry about that. Next chart, 10-year Treasury yield. Now, first of all, yes, we are definitely rising rapidly in our yields. But consider where we went. I mean, the yield went from 3.25 at the end of 2018. That was trade war. We were up 3.25. and then dropped down to, half of that. And then the pandemic hit. We went all the way to zero or close to zero. We've now just made our way back. We're at an 11-year high, and everybody's freaking out over high interest rates. But before you freak out too much, let me just pull up a 50-year chart on this 10-year treasury yield. And I want to show you where we are right now relative to where we've been in history. Are our rates really that high? I mean, honestly, 2018, we were at 3.25. We went through a pandemic. Fed did their magic, went down near zero. And now we're back to where we were. This whole period from 2009 to 2017 was 1.5% to 3.25. I think we're going to top. I don't know if we go through 3.25 or not. Maybe we do, but I think we are going to top fairly soon in the yield. And I wouldn't be surprised to see us back down at 2% again. And do you know what that's going to do if I'm right to growth stocks? They're going to explode back to the upside just when everybody's given up on them. And then the hardest thing is to get out of them, take a loss and then watch them go higher and try to get back in. That is a difficult part. And for the most part, we've tried to stay away from the growth stocks, even in our portfolios, which stay fully invested all the time. We've cut back quite a bit on the growth stocks, waiting for a better opportunity to get back into them. And honestly, and the couple that we have are killing us right now. I mean, our portfolios would be doing really well if we had just gone all value, but that's really not, our forte. That's not really what we want to do, and especially not over a long period of time. But anyway, 10-year treasury yield, 3.25% if we get there. It's really not that big a deal. But to listen to the media, you'd think that this was the end of, this was a financial apocalypse coming. All right, so here's the S&P 500. This was one of the warning signs back in December, by the way. Price kept going up on the S&P. Look at the XLY, XLP, that ratio. Falling apart. And even when we had this huge bounce, really, we didn't bounce much, went right back up basically to where we were before. And now we actually broke down in this ratio back on April 25th, right after that. And we hadn't broken down the S&P. And that was one of the things I said, we're probably going to go lower because this ratio is breaking down again. And sure enough, the S&P 500 is coming to join it. So this is a really important ratio. What I would love to see at some point is I want to see the S&P go down, bounce, and go down to a lower low, and see this XLY, XLP bounce and go down to a higher low. Lower low on the S&P, higher low on this ratio. That would be a really good sign and something we'll be looking for over the summer. All right, that's all I had for that. So that's current conditions. So now I want to go into the sector relative strength with you. And so the first thing I wanted to point out was over the last 3 months. So since the last draft, I want you to just take a look at what has been doing well and what has not. Energy up 28%. Well, let me say this. Energy relative to the S&P 500. So energy is 28% above what the S&P 500 is doing. Utilities, 20%, consumer staples, 16, materials, 10, healthcare, 8. Here's real estate, 4. I mean, it's energy, materials, and the defensive groups. You got industrials barely outperforming real estate right there. And then look at the bottom. What's not performing well? Financials, technology, communication services, and consumer discretionary. Why is the market going down? It's because those areas of the market that are most heavily weighted in the S&P 500 are getting killed. Pretty simple. And back at the beginning of the year, I said when the large cap growth stocks started to take their hit, which I felt was coming, that's when you would start to see the S&P 500, because everyone's saying, well, it's only down 13%. It's not a bear market. Everything else is down more than 20%. The only thing holding up the S&P 500 was these large cap growth stocks. And now they're falling apart. How much is Amazon down now from the high? 1,400. Google, remember when that earnings report, it went over 3,000? That seems like 5 years ago now. Facebook, Meta Platforms, absolutely crushed PayPal crushed. The semiconductors, as good as stocks as that we have in the semiconductor space, NVIDIA, just getting torched. And so as these large cap growths continue to sell out, it's going to be hard for the market to bottom at the current price. But I do think we're going to bottom, and I don't think it's that far away. So anyway, that's what we've been looking at the last 3 months. Now we could go through the individual charts. Here's technology relative to the S&P. So here's technology topping at the beginning of December, by the way. Remember, the S&P topped right at the beginning of January. Technology, which is the biggest component of the S&P, topped at the beginning of December. So we were already starting to see rotation out of technology at the last S&P 500 high. Then consumer discretionary. Look at that top. That was back in November we topped. And look at the relative weakness since then. Consumer discretionary still under fire. I don't think we're going below this low over here. So this is one I would be watching. As we get closer and closer, I think we're going to hold that area on this relative chart. Communication services. This one topped in September. These are the three aggressive, the three that I watch the closest. These are the three sectors I watch the closest. On a relative basis, now they actually topped back in March, communication services. But I would say September is when this fall really began. September on communication services, November on consumer discretionary, and beginning of December on technology. And yet, without these three groups, the S&P 500 somehow managed to set a new high at the beginning of January. And the reason they did it was because a lot of this money initially coming out of these groups didn't leave the market. They went into defensive groups. It was rotation. And that is a great sign to follow for the market. When you're getting close to a top, that's almost always what happens. Money rotates heavily towards those defensive areas. All right. Industrials actually moving, doing pretty well, probably up at about a 10-month relative high versus the S&P 500. So we are seeing some movement back to the upside in industrials, which is a good thing. It's not the three really aggressive groups, but this is, industrials are tied very closely to our economy. So I would love to see industrials continue to perform well, and so far they are. Financials, still not so much, mostly sideways, down the last 3 months, but mostly sideways the past 10, 12 months. How about defensive areas? Healthcare, look at that move up. Money rotating into healthcare. Consumer staples, look at that. That's consumer staples. And now let me show you consumer discretionary again. It's like a mirror image. Consumer staples, why would they be outperforming? Why would they be killing consumer discretionary? Well, in a recession, you're still going to buy soap and toothpaste and those things at the same rate you were before. You might not buy Starbucks latte at the same rate. You might not buy, you might put off that new car purchase or new home purchase, or you might not go necessarily go shopping as often as you did for, apparel retail stocks. Those things may not do as well, because those are companies that sell us the things we need, or the things we want. That's discretionary. The things we need are staples. So anytime you see staples doing well and discretionary not, that's really not a good sign. Real estate, it's come down over the last month as rates have really gone spiraling higher. But overall, you can see the trend has been to the upside. Another defensive group there. How about utilities? This has been one of the best runs utilities have seen in a while. Remember the trade war into 2018? Look at utilities. When the market's fearful, that's when utilities on a relative basis do really well. And that's why we're doing well here. Notice it started in November, right about when consumer discretionary and technology started falling apart. But Peter Schiff's telling us that they're about to collapse. So got to remember that. Little sarcasm. And then energy and materials. I mean, energy doing really well, materials doing really well. Only thing I would say here is I'm okay sticking with these groups until they don't work. And I say that because the dollar is strong, and normally these groups don't do well when the dollar is rising. But we're in a post-pandemic environment where, like I said, none of us have a handbook for how things are supposed to go. It's really fly by the seat of your pants to some degree. And, I think some things I think are easier to predict than others. I think when you follow the rotation, Wall Street tends to get things right. They make a lot of money. There's a lot of money at stake, and somehow they tend to get it right more often than not. Really big surprise there, huh? But they got a lot of sharp people working on Wall Street. Goldman Sachs hires nothing but the best. Anyway, so that's how the sectors are looking. Now, individual industry groups. Here's the industry groups for the last 3 months relative to the S&P 500. Now, the way I set these up is I've got all the sectors numbered. So you're going to see 001 to 00 or to 011 from 1 to 11. 11 being materials, 10 being energy, 1 being technology. So the higher the numbers are here, you're either in energy, materials, or defensive. Anything above 5 is going to be defensive. So 9, there's 2 utilities, there's 10 energy, 6 healthcare, 8 real estate, 9 utilities, 7 consumer staples. You can see that's going to be mostly defensive groups that are leading over the last 3 months. So this is where the money's rotating to right now. So when I start thinking about putting together portfolios, I mean, I can jump into the growth stocks and hope that they recover. I don't think that's a great idea at this moment in time. I do think they're going to get a big bounce probably sooner rather than later, but I don't know that they've reached bottom yet. So this is what's leading. And you can see there's coal. Then you got a couple of energy industry groups. You've got materials. You got steel, miners, gold mining. Defense continues to do well. That's one of the few in the aggressive areas that's in industrials. Of course, that was when the war broke out. We started seeing a lot more money rotating into defense stocks. But outside of that, I mean, here you've got fixed line communications, and those are the only 2 aggressive groups in the top, 15 or so? Now, you want to know what's not been working? You can probably guess. Might not guess tires to start, but that's tires, number 1. Gambling stocks, consumer discretionary. Travel and tourism, consumer discretionary. Recreational services, that's consumer discretionary. Transportation services, industrials. Broadcasting, that's in the communication services. Broadline retail, discretionary. Then we got a real estate, that's a defensive group. Then we got clothing, that's in discretionary. Footwear, discretionary. Specialty retail, discretionary. Asset managers, financials. Then we got a materials, aluminum. Semiconductors, there's your first technology. Semiconductors underperforming the S&P over the last 3 months by 12%. But that's just a quick, way to look at. Now, I can go through each one of these individual charts to show you what consumer or what all these different industry groups. This is computer services in the technology area. This is a 3-year relative chart. Computer services going down. Then we get into semiconductors. Semiconductors were going up until November. That was right about when I started talking more and more about potential recession. Maybe it might have been a little later than that. Maybe it was December, early January. But that's when these stocks really started getting hit, was when the market started becoming more fearful of a recession. Software, look at the relative weakness in software. It is now at the lowest level that it has been in more than 2 years. It's at a 2-year relative low to the S&P 500. That's how bad software has been for the last 7 months. I think it's going to be a great area, but when? I don't know. when interest rates peak and start coming back down, you're going to see money rotate heavily back towards software. You could do it now, but you might be a little early. You might have to ride out some scary moments over the next couple of months if it continues to get hit. Then you got electronic equipment. I mean, I'm not going through all these, but there you can kind of see what's going on in technology. How about if we looked at some of the discretionary clothing and accessories there, moving to a 3-year low on a relative basis. Home improvements coming up the last month or so, but still overall in a downtrend. There's your recreational services moving down to about maybe a 20-month low, relative low. Apparel retailers got a bounce recently, but still in a downtrend. Specialty retail absolutely collapsed since November. And a lot of these, when you start thinking about the groups that are really starting to weaken or really started to weaken back in November and December, many of the consumer discretionary areas, that was when, in my opinion, it became a recession issue more so than an inflation issue. The thing is, the recession is going to help us tame inflation, because when you have a recession, you have less demand. So it makes perfect sense that, I think this is that, the Fed's not worried about raising rates and losing the economy for 3 to 6 months. Fed could care less, because that is going to help them fight inflation. They actually want the market. They want the economy to slow. So we're pretty much going to have a recession. I think it's going to be a mild one, but I think we're going to have one. That'll help get inflation in check, rates come down, and then we're right back to the races again. That's my call. We'll see. Anyway, I'm not going to go through all these individual charts. Let's look at the stocks. So what can we do with the stocks? Now, this is the latest strong earnings chart list. For members of Earnings Beats, I will be updating this hopefully tomorrow. It's going through earnings season the last 2 or 3 weeks. Well, since the 25th. And I think that one may have updated through like the 22nd or 23rd. But we've just gone through 2 weeks where we've probably had over 1,000 earnings reports each week. And so I'm going through all of these, looking at which earnings reports, which companies deserve to be on our strong earnings chart list. Now I have to go through and annotate all the charts. I'm going to try and have it done by tomorrow. It might be Wednesday before I can get it out. But this will be updated along with some of the other chart lists as well. Try to get them all updated here over the next couple of days. Anyway, this just tells us over the last 3 months which stocks on this list have been going higher. One thing, that I'll say about this chart list, and you can go in here and add sector and industry group, and then you can sort it by sector. And so when you go through and you start looking at the number of companies in communication services that are on our strong earnings chart list, not that many. I mean, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16 in communication services. If we hit the edit, we'll find out how many are in here total. 389 right now are on the strong earnings chart list. Only 16 of them are in communication services. That's only about, 4%? Not very many. And then you go into discretionary. Usually we have a ton of discretionary stocks, and there are a lot on here. I mean, you can see, but not nearly as many as we would normally have. And do you remember a year ago? I think on our strong earnings chart list, I don't think there were any energy stocks, or maybe there was 1 or 2. Look at the number of energy names now that are on this strong earnings chart list. More than discretionary probably, or just as many. That's where the earnings are. That's where the money's been rotating to. So it makes sense that that's an area that's getting a lot more love from us in terms of being on this chart list. Then you've got the financials, healthcare, a lot of healthcare, industrials, getting more and more of the industrials. That's a good sign. Materials, bunch of material stocks. Energy and materials were 2 a year ago that we had hardly any. And now you can see a bunch of them on here. Real estate, normally I don't have many. Look at all these real estate names on here. consumer staples, boring staple stocks, and then technology. Normally, I would probably have 100 to 150 technology names. I don't know how many I'm going through right there, but maybe there were 40. And then utilities, 9 utility stocks, which is unusual. Normally wouldn't have that many there. Whole point here is just it's showing us that as I'm adding, and the relationship here will probably change as I add more and more from the last 2 weeks and get rid of some of these older ones. If you're not familiar with this chart list, what I do is the one that's in here, that's the oldest, it's chronological, it's in chronological order. So as I add more and more companies to this list, so for instance, WRB reported probably a couple of weeks ago, it's probably right in here where WRB, or maybe it was right in here, I don't know. But that's when they would have reported and got added. Nothing since that date. So these next ones I put on are going to be companies that have reported over the last 2 weeks. But if we go back to the earliest one, which is ACLS, they reported probably back sometime, I'm guessing in March, maybe February, but probably in March. I'm not sure which one of these days. I don't think it would have been this late. No, I'm pretty sure it would not have been that late. It should have been sometime. This might have been in early March or something or whatever. Anyway, these companies, as they get further and further pushed back, they'll come off of the list as they approach their next earnings date. That's how this strong earnings chart list works. And the only way they can get back on the list is they have to beat Wall Street estimates as to both revenues and earnings per share. And then when I look at the chart, there has to be something compelling about the chart. Either the stock is doing well, maybe the stock is doing well versus its peers. You can see ACLS was at a 52-week high just 2 months ago against the semiconductor group. So that was a good thing. It could be that I like the AD line. You can see the AD line 2 months ago was very strong. I don't know. It could be any number of those things, or the stock is just looking good. But that's, how we go through there. So what I'm going to be doing is I'm going to be going through the strong earnings chart list. This is where we get most of the stocks for our portfolios. And I'm just going to be looking at them. I'll probably start to narrow it down by looking at something like Candle Glance, where I can take a look at 30 of them at a time. And I'll just be looking across just to see, okay, is there something that's really standing out to me? Well, I mean, there's Consolidated Energy. That looks pretty good to me. AD line's going up, price action's going up, and it's in the energy space. It's in a good area. I mean, that's one that I certainly would consider. Here's another energy name. You're going to see energy names being considered because of what's going on in those stocks. So again, I'm just going to quickly be scrolling down to see. Here's a really nice move here. Came back down into gap support, but that was a huge move on big volume. AD line looks strong. That's probably one that I would go back and take a look at. Bungie, BG. This one's been in a nice uptrend. AD line's been rising with it. So these are stocks that are performing pretty well in a market that's not. And so that's what I'd be looking for until we see things begin to change in terms of growth stocks. We're going to, go with what's working. Here's Disney, which was on here from a few months ago. But look at Disney over the last 2 or 3 months with that Netflix news not that long ago, losing subscribers for the first time in 11 years. A lot of the streaming, any of the companies have streaming, Disney, Roku, they're all really struggling right now. So Disney has come down a lot. Do I think Disney would be a great buy to hold for a while? Sure. But from a trading perspective, I mean, from a momentum standpoint, there's no reason to buy it yet. Not showing anything. But if you're somebody who likes to try to buy on weakness, Disney, I think, would be very interesting. GSK, there you're looking at healthcare. Just recently set a new 52-week high, pulled back. Maybe the pullback represents an opportunity to have to look at that a little bit more closely. Mattel, just recently broke out. Nice volume. AD line took a nice move to the upside. But this is what I do in going through. I just take a look, knowing what I know now about the market, the overall big picture, what's working, what's not working based on the sector and relative strength and the industry group relative strength. And I start going through these individual stocks, and I'll just start making notes on which ones I like. There might be a certain area that I really like in the market. So what I would do is come in here under summary and, maybe search for, now semiconductors are not the ones I'd be looking at right now, but I could pull up, give me all the semiconductors. And then if I add scooter score, come back over here, I can sort it in scooter number order, and I can see which ones have the highest scooter score or a stock charts technical rank. Now, I might look at non-durable home products. Well, there's one, Kimberly-Clark. I might pull up, I don't know, let's do exploration and production. And there you have those in scooter order. So these are some of the stocks I'm going to look at first. I can tell you right now, Devon Energy, that's in one of our portfolios. PXD, that's in one of our portfolios. So these are already, they're helping our portfolios because they didn't help it today. Energy got hit really hard. But these are stocks that have been doing very well based on that scooter score. And if we go back and look over the last 3 months, you'll see Devon up 20%, PXD up 12%. So they've done well throughout this period, even though they had a rough day today. But there's a lot of different ways to look to find stocks that you want in this for the portfolio for the next 3 months. And that's what we're going to be doing in 10 days. So that's essentially what I had for today. All of these, this strong earnings chart list, by the way, we make available to all of our members at Earnings Beats. All of our chart lists we make available. So if you are new to Earnings Beats, if you want to try us, we do all this research, and then our members just download it into their Stock Charts account. And if they're not Stock Charts members, you can always still review the chart list. You can look at the charts and scroll through them one at a time. You just can't download them because you don't have an account to download them into. But anyway, if we have any questions, I'll be happy to answer them, John. Otherwise, we're good.
Yeah, not too much, but I noticed a couple of stocks after hours that just sort of encapsulate what's happening in the market. Take a look at Upstart that reported. They beat estimates, but they lowered their earnings going forward from 1.4 billion to 1.25 billion. And the stock is down 50% after hours.
I'm looking at it right here. Yeah, 44%. That's quite a haircut. And that's after it was $260, by the way. That was back in November.
Yeah.
260, now it's 43.
This is what we're dealing with today.
Yep. Teladoc was one. I mean, that's a big stock for Kathy Wood. And it's 140 in November, but remember, that was a $300 stock. Today, it closed back down at $30 from 300, 90% off.
Yeah.
But according to Peter Schiff, technology is about to collapse.
So a couple of questions.
Yeah.
One of the picks come out, and then why is bond yield up today? Means bonds are going up.
No, the yield went down today, I think. The picks come out next Thursday, by the way. But if we pull the 10-year treasury yield, no, we came down today. So when the yields go down, it means prices are going up. So it means you've got more buyers. So you've had a lot of selling in treasuries, which has driven the yields higher really since back in December. And this, to me, this was one of the reasons why I started talking about recession versus inflation, because normally you would see yields going up during inflationary periods, because who wants to hold a bond that's not protected, that's not inflation protected? I mean, if you're holding a bond and it yields 2% and you're in a market where you've got 6% inflation, you're losing 4% on your money. So, but yet when we had all the inflation picking up the beginning of last year, I'm going to take this back a couple of years. We'll go back 3 years on the TNX. So we had inflation start picking up in February, March, and April. That's when it really began to soar last year. Here we saw the 10-year Treasury yield go up. And then the rest of the year, it basically just went sideways to down. That is not what would happen if the market was really worried about inflation. What would happen is you'd be seeing a lot of selling of the treasuries, and the yields would be skyrocketing because investors require a higher return if they know that they've got to outperform inflation. So I was looking at this last year saying, well, the bond market's not expecting inflation to last because yields are not going up. So they're not pricing that in. And in 2022, look at the difference. Now, all of a sudden, is it now that we're all of a sudden becoming worried about inflation, or are the yields, which I think it is, I think it's the combination of, the Fed starting to raise rates. I mean, obviously that's one thing, but I think that the rates going up and the folks getting out of bonds, I think part of that is that, we're looking at the possibility of a recession ahead as well. So I think you got people getting out of bonds and you got people getting out of stocks. Now, maybe some of the bonds activity is related to inflation. How much, I don't know. But I do know this: when inflation peaks, and again, I gave you some information earlier in this webinar to kind of digest. You can agree with it or disagree with it. But I think inflation, with last month's reading, that might be the highest reading we see with inflation. Feel free to disagree with me. That's fine. I think that could have been the highest one we get, though. And if I'm right, I don't think it's going to be long before we top in yields. And if I'm right and the inflation comes down and the yields come down, all of a sudden, all the folks that have been selling growth stocks are going to be scrambling over each other to buy them. We'll see. And I think probably what's going to happen is this whole crew that's been so bullish the market for the last 2 years is going to turn bearish and think that you just make money by shorting. And when everybody gets to that point and we start seeing that equity only put call ratio get up to 0.80 on a 5-day moving average, that's really what I'm looking for. If we get to there, I will be much more heavily invested in the stock market. That's kind of the threshold. That's the thing I'm looking for. And it might take the S&P getting down to 3,500 to get it done. I don't know. But yeah, John, you raised some good points.
Let's wrap it up here soon, but just as a thank you from somebody, say you've been a great help understanding the market. Somebody said he wants to buy the dip in the market. How do I go about it? I would like to buy the QQQ.
It depends on whether that's a short-term trade or a long-term position. If you're looking long-term and you're thinking about, working your way into a position, I would be starting to buy the QQQ. Like I said earlier, 25%, 27% down on the QQQ. It doesn't happen very often. And we always want, it's that confirmation bias. We want to see it going up before we get in. We want to feel like we're making the right decision. Usually the right decision is to buy it when it's coming down. So I would be using weakness over the next few months. My target personally is to be fully invested by September. And I don't know exactly how that's going to be. It'll probably be in some of the portfolio stocks because I like to trade those. And it'll probably be some QQQ, maybe some spider. I don't know. But I fully anticipate at this point being fully invested by September.
Okay, I think on that note, we could wrap it up here.
All right. Thanks again for coming in. I hope you found it educational. For those of you that are Earnings Beats members, you probably saw mostly a refresher course. But hey, we're going to keep watching it. We were able to call the top. I hope that things set up where we can call the bottom. That would be great. But I do think getting in slowly makes a lot of sense because it's not always, it's not always easy to catch the exact tops and bottoms. So working our way in to some of these positions, especially ETFs during periods of weakness, makes a lot of sense to me for the long term. Anyway, that's it. Appreciate you coming in. Take care. Have a good evening. And tomorrow be back over at Stock Charts TV for the next Trading Places Live. Take care, everybody. Happy trading.